For a guy who spent 2 decades teaching philosophy at the University of Kansas, Don Brownstein has done pretty well in finance. Make that very well in finance. Brownstein had the world's best performing billion-dollar hedge fund in 2010. Structured Servicing Holdings, his flagship fund, was up almost 50%, and that's on top of a 135% gain in 2009. Structured Servicing has returned an average 28% annually since Don started it 13 years ago. You can say it's a Bloomberg best. And the magician himself, Don Brownstein, is here with us on the InsideTrack this morning. Don, welcome. Good to see you
Erik,
here.
how are you?
And congratulations. I have to say, those are pretty amazing numbers. You call your firm Structured Portfolio Management. I just mentioned one of the names of your fund, Structured Servicing Holdings. They're kind of ambiguous. I think what people really want to know is, what do you do? I know that you're in the business of trading mortgage-backed securities, but how do you make money? How does SPM really operate?
Well, I can tell you, first of all, that I'm lousy at names. I almost named my first son Ambrose 36 years ago, so it hasn't really gone uphill very far from there. I'm not really allowed to discuss either the numbers you folks came up with or our specific strategies. Everybody knows that we do a lot of our business in the mortgage-backed securities arena. We do a bunch of other things as well, fixed income.
But one of the things that you have focused on over the years is prepayments. Why are prepayments so important to investing in mortgage-backed securities?
Well, for the most part, mortgage-backed securities until 2007 were regarded as being pretty safe in terms of defaults. There were low default rates, and that was pretty uniform across the board. And so the real question that arose was, when would people be paying their loans off? Most mortgages give the mortgagor, the homeowner, the right to pay their loan off early at any time. And so predicting when they would be paying their loan off becomes crucial to understanding what the yields will be on your security.
So what prompted you initially to begin to take a closer look at prepayments when, as you point out, the prepayment history had been so benign?
Well, it's not that the prepayment history had been so benign. Default history had been benign. What was interesting, actually, to me...
In fact, in many cases, prepayments are anything but benign, and they happen all the time with refis, right? When
I first got into the business in 1988-89, prepayments were pretty low. And what happened is in 1990, when the Fed began to move rates, prepayments picked up dramatically. When the 10-year bottomed in October of 1993, at that point there had been 3 plateaus of rates, and prepayments had accelerated way beyond what anybody had thought for each of those drops in rates. So that was one of the questions which interested me, was why, and why there was so much variability in the response of mortgagors to a given rate environment.
So did you go then and build your own custom database and your own custom computer models to track these things?
Well, I'm not a computer scientist. I don't do software development or anything like that. I have people who do that for me, and I did when we were starting out. I was actually more interested in the intellectual question of why it was that people who you would imagine would behave pretty much alike were behaving so differently when it came to exercising their prepayment option. And I try to understand why that was the case.
With a track record like the one that you have, in 13 years, only one losing year, it can't all be luck, clearly. You have to nail the big picture. And what I'd like to know is if you've had a consistent macro view over that period of time. Are there some things that have guided your investing philosophy the whole way along?
We tend to think about, there's an old saying, it's better to be lucky than good. Well, I disagree about that. I think it's important to be good at what you do, and the way you get to be good at what you do is through, in my opinion anyway, understanding deeply what drives things, what makes things work. So for us, what we looked at were the structures that were present in the residential mortgage-backed security market, the mortgage market. And we tried to understand the differences in prepayments amongst mortgagors in terms of those different market structures, which are not ephemeral. They tend to be longer lasting.
Don, earlier you were talking about your intellectual fascination with issues of policy and markets. I want you to talk to me about QE2, Ben Bernanke's grand experiment. What are your thoughts?
Well, I think it's important to think about it in just those terms, as a grand experiment. And today we heard that former chairman of the Fed, Paul Volcker, is leaving the president's service. And in 1980, we had what I would describe as a Volcker moment, or the Volcker moment. And I believe that the QE policy that was announced in November is in fact going to be regarded down the road as the Bernanke moment. What Volcker demonstrated was that it's possible to whip inflation by the use of monetary policy. What I think is on Bernanke's mind is to demonstrate that we can avoid deflation and the liquidity trap that accompanies it by whipping deflation.
But you're absolutely certain that Ben Bernanke's focus is on deflation alone. It has nothing to do with American competitiveness. It has nothing to do with the dollar. It has nothing to do with many of the things that people have accused Ben Bernanke of prioritizing.
No, I think that the Fed is on target with respect to its dual mandate. As they stated, the dual mandate under the Humphrey-Hawkins Act is full employment and price stability. And I think at this point, it's probably more difficult to explain to the public what price stability really means. On the other hand, I think it's a lot easier to explain what full employment means. And I know that the Fed has done a study recently to characterize what used to be called NAIRU, the non-accelerating inflationary rate of unemployment. So I think that they're headed for that.
Don, you spent a lot of time looking at fixed income markets. People have said that Fed policy and fiscal policy have distorted conditions in fixed income markets and prices. What do you think things would look like today had the Fed not introduced quantitative easing and then subsequently QE2?
You know, before Copernicus, there was the view that the Earth stood still and the sun moved around it. And that was the view which basically held that the universe was static, that there were distortions created by outside effects, but the universe was inherently static. That turned out not to be true. And I think people who believe that policy is somehow or other exogenous to the behavior of fixed income markets are just deluded. The Copernican revolution took place a long, long time ago in physics, and it's about time that something like that took place in finance.
All right, Don, great to have you here on the Inside Track. Don Brownstein, he was a philosophy professor, and you could kind of figure that out by those references to Copernicus. He was, according to Bloomberg Markets magazine, the top performing hedge fund manager in 2010.